The most dangerous lie in financial history was never hidden. It was celebrated, praised, awarded, trusted by investors, bankers, and auditors. Even the people whose job was to question everything. How could one company convince? But how could they convince the smartest minds on Wall Street that an illusion was real? Or did they simply choose to believe it? Tonight, we reopen case file number 2. For years, the company appeared untouchable. Wall Street praised it. Banks financed it. Auditors approved it. The media celebrated it. Investors trusted every number they were shown. But behind that confidence was a question almost no one wanted to ask. Perhaps they never saw the truth. Or perhaps the truth was too profitable to confront. In the beginning, the company was built on something real. Pipelines and gas fields. Steel stretching across thousands of miles. Every asset could be measured and inspected. Every product had to be delivered. But the energy market was changing. Our merger creates the most extensive interstate pipeline network in the United States. A new generation of executives believed the old rules no longer applied.
This report confirms it.
Energy does not have to remain a physical commodity. It can be traded and packaged, priced years before it was ever delivered. The company discovered something extraordinary. One signature records profits today for gas that won't flow for 20 years. A contract for future profits could make the present look successful. The market only needed to believe that money would exist tomorrow. We are no longer a pipeline company. We are a platform for the new economy. Investors saw innovation. Wall Street saw unlimited growth. Confidence became valuable. Doubt slowed deals. Questions threatened projections. Failure was pushed into the future.
There is a discrepancy in the projections here.
The numbers reflect our long-term confidence. We do not look back, we look forward. The first illusion began with time. A contract could promise profits for years to come. But the company did not have to wait years to report them to the world. It estimated what the contract might eventually earn and placed value into today's results. If the project succeeded, the estimate appeared brilliant. But when the project failed, profits remained. Removing it would mean admitting that the growth had never been real in the first place. So the loss needed somewhere else to go. The solution was not to erase the asset. New legal entities were created for specific, narrow financial transactions.
This provides distance.
But they must appear completely separate. On paper, they stood outside the company. Inside them, troubled investments and risks were hidden. Each transaction had documents, lawyers, banks, and signatures. Every single piece appeared quite technical. Viewed one at a time, every piece appeared defensible, almost ordinary to the untrained eye. The balance sheet confirms a period of sustained growth. Our commitment to shareholders remains unwavering. We've moved the obligation into the new entity. They could record a transaction, protect a reported profit, and keep risk outside the frame. Even the protection sometimes depended on the company's own rising share price in the market. It was a mirror supporting another mirror. While the reflection multiplied, The company appeared unstoppable. But the machine required one thing. The market could never stop believing in the growth. The warning signs were never invisible. They appeared in fragments. Earnings rose. But cash did not rise with them. Every warning arrived alone. Our business is complex, and traditional accounting cannot measure our future growth. We can move past this now. No more discussion. The market understood what critics did not, and the share price kept rising. Projects described as successful looked strangely quiet and inactive in the real world. Financial statements became harder to understand as connected entities appeared in footnotes. Some employees raised concerns, but doubt only created professional isolation and fear. The warning became increasingly distant from the person who had first created it. The discussion focused on reputation. No one began a broad, independent investigation. Some auditors noticed dependencies, but were directed back to the assigned scope. Banks did not want to lose fees. The meeting continued without hesitation. Journalists did not want to dismiss the company everyone else called revolutionary. Inside the company, questioning a number could mean questioning the entire culture.
Look, Jennifer.
Your performance is just not meeting the targets. Almost everyone benefited from leaving the fragments apart. Challenging the story meant standing alone. Enron only needed each person to ignore the piece directly in front of them. A public company is not supposed to depend on trust alone. The trajectory is undeniable. These results speak for themselves. We are ahead of schedule. Directors oversee management, and auditors examine the complex accounts. Banks evaluate risk, while analysts question the company's daily performance. Journalists challenge the public story, ensuring that executives cannot verify themselves. But the greatest strength was proximity to people responsible for questioning. The board received presentations, and complicated transactions were reduced to summaries. The auditors saw more detail, but were part of a valuable relationship. The banks understood the money and helped create transactions for cash. The company received liquidity, while the banks received significant fees. The analysts watched earnings rise, while cash remained difficult to explain. Negative conclusions could threaten access, clients, and investment banking relationships. Good evening, Mr. Thompson. Please tell us about the current situation. No single group needed to understand every part of the structure. Responsibility moved in a circle, and everyone claimed someone else examined risk. It was a system where everyone had information to feel uncomfortable. For years, the system survived every warning. Every difficult question found another explanation. Every concern found another report. Every concern found another report. Every inconsistency found another promise. The questions themselves began to change. Analysts stopped asking how fast the company grew. They began asking whether the numbers could still be trusted. Banks stopped asking for business. They began asking how much risk they already carried.
We've run the numbers a dozen times. The valuation is sound.
Journalists stopped celebrating innovation.
Are you certain?
They began comparing today's answers with yesterday's promises. The market did not discover secrets overnight. It slowly stopped believing the story. Confidence disappeared first, then liquidity, then protection, then options. The structures that once looked sophisticated suddenly looked fragile and broken. The transactions that once inspired admiration suddenly demanded explanation. The company spent years transforming expectation. Now expectation moved in the opposite direction. Every falling dollar weakened the very structures built. The mirror no longer reflected confidence, it reflected doubt. And once doubt became visible, it spread faster than any accounting entry ever could. The collapse had already begun. Our foundations remain strong despite the market noise. The company still exists physically, but the confidence that held it together has disappeared. The system did not collapse because the truth appeared. It collapsed because belief disappeared. When this energy giant entered bankruptcy, the collapse was described in financial language, but the consequences were personal: debt, credit, liquidity. But those words concealed the direction in which the damage moved. At the top, it was a legal problem. For employees, it became a life problem. The trading floor slowed, termination notices arrived, and desks were rapidly emptied. Thousands of workers left a company that had once presented itself as the future. But many did not lose only their salaries. Their entire financial future was tied here. They had been encouraged to invest their life savings in the very company employing them. When the stock collapsed to zero, their hard-earned retirement disappeared in an instant. The consequences were not distributed equally. The institutions closest to the machinery had protection. In bankruptcy, every loss entered a hierarchy. Secured lenders always stood at the front. As the collapse widened, institutions began separating themselves and narrowing their responsibility. Senior executives had elite advisors, while ordinary employees faced long lines of uncertainty. The illusion of wealth had been carefully constructed inside the executive boardrooms. But it did not collapse there. The real damage fell heavily upon kitchen tables. A massive company collapsed. But did the financial system that created it actually change? After Enron collapsed, the system demanded individuals it could name. Investigators moved in. We've confirmed these records are the crucial link. Former insiders explained how the complex corporate structures had originally worked. Charges were filed, and courthouse steps were filled with cameras and lawyers.
Courtrooms translated years of financial complexity into much simpler questions of guilt.
Look at this timeline. It shows exactly how the fraud was executed. What did the leaders know? And when did their optimism become deception? Some corporate executives were convicted, while others quietly accepted their legal verdicts. Some cases ended abruptly before the full process of justice was completed. The major audit firm that approved the accounts quickly collapsed and disappeared. Large banks and international financial institutions eventually negotiated massive civil settlements. Settlements reached enormous figures, but lost employee savings could not be restored. New laws tightened internal controls, executive responsibility, and auditor independence across systems. The corporate system became more cautious, heavily documented, and strictly regulated. Expanded compliance departments and risk committees monitored every daily transaction and report. But rules control procedures easily, while intense pressure to meet expectations survives. Had the system learned to recognize the illusion, or only document it carefully? Enron is now remembered as a scandal from another era. Yet, the patterns of corporate promises and collective behavior continue. A company built on false confidence, its collapse changing laws. How does reported growth convert into cash? We scale through future metrics. Because Enron did not rise in secret, it rose in public. Investors watched, banks participated, and independent auditors approved. And every price increase seemed to prove that belief was completely rational. Employees believed their savings and identities tied to the rising value. Traditional thinking cannot measure a company building the future. The methods will change, but the underlying structure remains identical. The warning is not the company. It is how quickly we stop asking questions. So if Enron appeared today, would we recognize it? The case is closed. The question remains. Keep questioning.